Today, I'm talking about the Isler method for saving on taxes. Suppose you're a sole proprietor, business owner with a wife, a couple teenage kids, maybe you're a consultant or you perform kitchen and bathroom remodels, and your gross income is $140,000 a year with about $20,000 of supplies and other tax deductions, maybe some mileage. Let's see how this looks using an approach with the minimal tax planning compared to the Isler CPA approach. Let's say you start with revenue of $140,000. You got a bunch of expenses, the deductions from supplies, equipment, mileage, maybe even some contractors, and that cost you $20,000. So you'll have a net business income of about $120,000. From that, you're going to have a self-employment tax deduction of about $9,200, qualified business income deduction of $24,000 from the new Tax Cut and Jobs Act, and a standard deduction of $24,000, which gives a net taxable income of $62,800. The ordinary tax on this is about $7,100. Self-employment tax is another $18,400. Yeah, you'll get your child tax credits of $4,000, which leaves you a federal tax liability of about $21,500. And keep in mind, states like Oregon is going to add another $5,400 in taxes on top of that. Now, supposing the same person decides to use the Isler approach to tax preparation and has their business taxed as an S corporation. Now, you're going to start again with your revenue of $140,000. You got the same expenses and deductions, supplies, equipment, mileage from contractors, and it's going to cost you that $20,000. Now you work with a CPA who helps you get a plan with deductible health insurance and maybe some other deductions that you didn't think of before. And you use actual on a new vehicle, and you strategize some travel costs, meals, tax preparation fees, and really scrape around the edges to get some deductions. And you get another $15,000 of expenses in there doing this. Next, we put you on payroll, so you get another $30,000 deduction. Yeah, I realize you're going to pick it up later, but you're saving self-employment taxes. Next, we put the two teenagers on payroll. And because they're working for an S corporation, we have to be careful. But if structured correctly, they will have no payroll taxes, nor income tax filing requirements. But you'll get another $20,000 deduction. And now you'll have business income of $55,000. Next, you work with Isler to get the correct retirement plan in place that is consistent with your goals and your salary. This could be another $14,000 deduction, combined with the standard deduction of $24,000 and the $11,000 qualified business income deduction. Remember the Tax Cut and Jobs Act? And you add back your wage you paid to yourself. This results in a net taxable income of $36,000. The tax on this, it's about $4,000. Remember, you get child tax credits of $4,000, so it eliminates your federal tax liability. Yeah, I realize states like Oregon, they're going to add another $4,000 in taxes in this case. And you've got payroll taxes of about $4,500. But that's part of your Social Security retirement, right? And it's certainly better than paying the $21,000 in taxes we calculated before.